Hi, I'm Peter Rose, founder of Longwood Currency Trading, and today I just wanted to take a little time out to chat about one of my favorite Jesse Livermore quotes. If you haven't read Reminiscences of a Stock Operator, that's probably one of the classic books in all of finance, regardless of the market, that folks read and kind of quote verbatim from. I think the reason that he's so powerful is because he made so many fortunes and lost so many fortunes in his lifetime, fortunes that dwarf the net worths of some of the richest people in the world today. He learned the hard way, and he came up as a speculator, and then he did a lot of long-term trades as well. So it's a nice mix of experience that he speaks from. And one of his most significant quotes, I think, that he has ever said is that the only way you get a real education in the market is to invest cash, track your trades, and study your mistakes. And I'd like to take each one of those bullet points and chat a little bit about them with you today. And a little bit of it will be, my experience, but most of it is generic experience that we all have, or we should have as traders. I think these are not just pithy thoughts from somebody as to what they did to succeed, but I think it's sound advice as to how to approach going about your trading education. And not only the educational part of it, but once you are a trader, no matter how long, you could be 20 years a trader, you still have to repeat these 3 steps every time you throw down against the market. You have to invest cash, you got to track that trade, and you got to study your mistakes, because you will make mistakes. Every time you hit the button, it could be a mistake. Nobody has 100% win-loss ratio, so it's part of trading that you have to make mistakes. And if you don't study those mistakes, you don't learn what not to do. And as Livermore said, the more I learn what not to do, the more I learn what to do. And so this whole quote of his is premised on invest cash. You've got to take a risk. You've got to put your money on the line. It's got to be real money. I traded in a simulated account for 4 years. I traded a simulated account a little bit to learn the plumbing, which is what I should have done. I opened a small account and traded that live with incorrect educational background, just trying to feel my way through. I ran that account to the wood. I reloaded that, ran that to the wood. I learned a tremendous amount doing that, but I didn't want to lose any more money, so I went into hibernation mode over the next 4 or 5 years, trading trading simulated accounts, and then writing thousands of lines of computer simulation software against the markets to develop a trading system like so many folks do. Re-entered the market with a large account because I was confident in my simulations. I was confident in the results that I was getting in the simulated account, which isn't worth shit. I mean, you just use the simulated account as a vehicle for learning the plumbing of trading, the technical aspects. How do you place the trade? How do you draw a trend line? What are moving average lines? Do you want to use them? That sort of thing. But the real trading comes when you put your real money on the line. That's where that comes into play. And so he's talking about investing cash, not investing hopes and dreams, but investing cash. Now, when we do that, there's 2 ways we can do it. We can have come out of a simulated environment, which you've got to do that. You've got to start out in a sim account. every broker out there will offer you 50,000 or 100,000 of play money, and if you're not careful, you'll use that money and you'll become this hero. It means your emotions are not attached to that $50,000, so you'll do real good in your trading. And then you'll go in and open up, excuse me, your real account for $1,000 or $3,000. Don't even fucking waste your time if you're going to invest less than $1,000, because if it isn't going to hurt, you're not going to learn anything. So, you know, most retail accounts, I think they probably average about $3,000 or something like that. That's not counting the guys that are in there for $300 or $400, which shouldn't even be in there. But I think that's the average that's in there, is about $3,000, because there's a lot of folks in there with several $100,000. You don't need several $100,000 to trade. You would need several $100,000 to build up a cash reserve of trading funds that if you lose those, you're not out any capital. You know what I mean? That's why you trade with a large account, is to build up your trading account. Your large account that you go in with is not your trading account. That's your bank to build profits, and it's those profits that then you use for your trading account, and it's the profits from that that you pull off and you pay your mortgage with, or you go to Bali or whatever it is that you want to do with your funds. But it's investing cash. That's the key to the thing. That's the first point, is it has to be real money. And the second part of that, as far as Livermore was concerned, he was balls deep when he'd go in. He'd push it all to the center of the table. Look, as you know, if you've watched any of my videos at all, I retired after a 40-year career as a real estate investor. I had a 33-year career as a senior software engineer. I'm a senior grandmaster in martial arts. I've been doing that for 50 years. You know, I've taught karate for 50 years. So I've done a lot of different things. But the real estate is what gave me the ability to retire. And when I went into investing in real estate, I understood that I had to get it right, because I had to come up with a lot of money as a down payment for real estate. And because it was investment real estate, I wasn't putting 5% or 10% down for a house. I was buying investment properties, and so they were looking for, back then you could get away with 20%, but 30% was generally what you were going to have to come up with in order to purchase a piece of investment property. So I wasn't making a lot of money. So the money that I came up with to put down in my real estate was everything that I had. I went to the wood every time I bought a piece of investment real estate. I took my bank accounts to zero, because I understood how to manage real estate, as we as traders have to understand how to manage our positions once they're established by taking the trade. So going all in real estate, I understood that if I was going to do that in currency trading, I'd have to be all in as well. I don't advise that when you're starting out. My process is, you open a simulated account for $1,000. You trade that until certain criteria are met, and then you open a live account with $1,000. I don't care whether you're a multimillionaire, but it's $1,000. And when you can replicate your perceived success from the simulated account, which is, that's not going to happen. You're going to lose that. You're going to go to the wood a couple of times in that account before you finally get it. Before you finally understand that what you learned in the simulated account is not trading. That's the plumbing of trading. You learn trading by what Livermore said, by investing cash, not fooling around in a simulated account. So when you invest that cash and you make a trade, you have to track those trades. You have to write down the metrics. When I started, I was writing every trade down so that I could see what that trade produced as a P&L and what the sum of the day's P&L was, what percentage of my bank that was, how many wins I had as a function of how many losers I had, what my largest winner was, what my largest loser was. And because I'm a software engineer, I wrote a program that does all these metrics for me. Most of the brokerage accounts and stuff allow you to do metrics, but not to the extent. There's a few metrics that I compile and put together and present in a little graph for myself, so I can see exactly, boom, 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 boom. This is how I'm doing. And I wrote that program in conjunction with a program that takes my transactions from a broker and puts them into a database and then produces my tax return form. I think it's an 8949 IRS form at the end of the year that if you go to a CPA and they haven't done that stuff before, your accounting will be something like $600. That's what my first tax bill was for a little dinky mini account, for goodness sakes. I mean, I had 300 or 400 trades in there. It cost me $600 for them because they didn't have any software to put in this report. And so they had to take each transaction, and they don't know how to do it. They don't know how to structure currency transactions, particularly when you're staging in and staging out. They don't know how to put that together. So it's a lot of money. It's a horror show. But those are the tools that you'll either have to find or you'll have to build for yourself so that you can track your trades. You have to be able to develop metrics. Your two most important metrics from a general educational principle standpoint is your win-to-loss ratio. How many times do you win for how many times do you lose? That win rate better be higher than the loss rate, or the amount that you win has got to be extraordinarily more than the amount when you lose. There's a balance, a trade-off between that ratio and what you're risking and what your reward is. And I've done videos or blog posts on my LongwoodCurrencyTrading.com website blog that go over this type of stuff. And I'll continue to do blogs and other videos that concern those types of metrics, how to properly look at win-to-loss and reward-to-risk ratios. But basically, those are sort of the main things that tumble out of when you're tracking your trades. And out of tracking your trades, you're going to notice, gee, in this particular time, I lost 4% of my account. You should be losing, 1% or 2% at the most on a trade. And so if you stumble in where you lose 4 or 5%, or you've lost 5 or 8% for the month, then that's you're making a mistake. You're making an error. And so you need to study those mistakes and find out what not to do. So as you're journaling your trades, where you're tracking your trades, you should be writing down, well, the reason I took this trade, or maybe not, who cares why you took the trade? You took the fucking trade because it met your criteria. But if it went south on you, you should jot a note down there. Well, I went out to get a cup of coffee and the price went against me, and I was stupid to go out and get a cup of coffee. Or I was leveraged up too high on that particular trade. Or, it went against me and I thought, well, I'm down on the 5-minute chart. And so I went up to the 1-hour chart and it still was within the confines of where the 21-period moving average was, and maybe it would bounce off that. Well, it didn't, so I found myself 30 or 40 pips out, and I had to close the trade, and so I was stupid. Those are really important things to write down on that piece of paper, and only where you made the mistakes, so that you can go down that piece of paper later on a daily basis, on a monthly basis, and say, gee, of the 15 mistakes, bad, stupid mistakes that I made during the last 2 months, out of those 15 mistakes, 8 of them were because I just let a bad trade run, and that's what you're going to learn. You're not going to learn because you write something down under each topic. I think that's the reason why a lot of folks don't journal. All the traders out there will tell you, you got to journal. You got to journal your trades. Sorry. And you just don't feel like doing that. You know, you take your trade and you're in and you're out or whatever. Or if you're a swing trader, you've got the time. You're only trading maybe a couple of times a day. You have the time to do that. I'm a speculator, so I'm doing, I'll do 20 trades a day, but I'm only trading for a couple hours, and I'm down on the 5-minute or the 1-minute chart. So I'm boom, 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 boom. Look, I get on the 5-minute chart, I get 12 times an hour to make a decision. So I can run a lot of trades out. So I'm going to fill up a piece of legal paper with the trade results and stuff, and so there'll be my little comment there. Well, I exceeded my loss tolerance or whatever, because I thought that by going up to the next highest time frame that it would respect bouncing off of that moving average line, or bouncing off that Bollinger Band, if you're dumb enough to play with these things. I have quite a few videos and blog posts on not using these indicators, because you get yourself in a lot of trouble. There are some indicators that you can use, but you need to use them differently than what I see being taught out there by most folks. Regardless, you're investing your cash, so it hurts when you lose. So when you track your trades, it should be important enough to you to write that reason for that loss down. Why do you think you lost that trade? Now, some of it is mechanical, like letting the trade run too far. But you also have to consider the emotional state that you're in, because 50% or more of your ability to be a successful trader or not is getting a grip on your emotions. You can't just mechanically trade. You know, there's a lot of controversy about trading by robots. Somebody's got to be behind that to look at the market and say, I got this gut feeling, as Curtis Faith would say, one of the original turtle traders. I got this gut feeling, and I'm gonna pull my chips off the table here. The robot doesn't know that. He's just going to keep on going through. So if your robot has a proclivity, for example, as a trend following robot, because you just can't build a robot that trades well in a chop environment, because there's too much chatter, there's too much chaos from a mathematical standpoint, fractalness going on in a horizontally chattering price for a robot to be effective. So the robot is looking within that chatter for shorter term trends, and eventually it gets screwed up. And because the robots are taking so many trades, the thing will just run itself until you got no money left. You have to be really careful about that. So you have to be the one that's in there learning this stuff and being in control. If you don't want to be in control, then go to Vanguard, put your money in an index fund, and forget it. And you'll get your 7.5%, 8.5% a year over the 20-year period of time. And look, your money doubles in about 10 years. It's 7%. So put your $4,000 into your Vanguard fund, and in 10 years that'll be $8,000. Everything takes a lot of money to get in and make a lot of money. You don't make a lot of money from a little bit of money. Some people do. Not everybody who sits down to write a piano concerto is going to be famous. You know, there's one guy, you'll recognize his name right away, Beethoven. One guy out of the gazillions of people that write piano concertos. Now, sure, Beethoven is a 1%. There's a whole bunch of folks at the 4% level that are really, really good, but they're not Beethoven, but they're really good and they're really successful. And then there's the rest of the people, the 16% that are left. 20% of the people are going to be okay. They're going to write good stuff, good music. They're going to make money trading, whatever. 20% of the people make 80% of the money. That's the 80-20 rule. And I'm a big proponent of that rule because I've seen it in real estate, I see it in martial arts, I see it in computer programming, applications development, and I see it in trading, obviously. So the point of the thing is that you need to be sure that in tracking your trades that you're writing the emotional reason down if you can't figure out what the technical reason was. Oh, look, it's very easy to point to something and say, I didn't get out of the trade soon enough. But that's insufficient. Why didn't you get out of the trade enough? Are you fucking stupid that you can't see that the thing is going beyond you, that you've lost 2.5%? Can't you see that? So you can't just say, oh, I exceeded my stop limit. There was an emotional reason. You fell in love with the trade. You had a bad day. You're sick. You went out to get a cup of coffee. That created an emotional reaction when you came back. Oh shit, the thing's gone against me. Well, it was moving in my direction to start with, so it'll come back. Yeah, it isn't going to come back. It's not going to come back. It's true, Jesse Livermore made fortunes, but he lost fortunes too. He went so broke he had to sell everything quite a few times. He died broke. A lot of people say, well, he died broke. How good was he? Because he made, during the stock market crash in 1929, 1930, he made $1 billion, the equivalent of $1 billion. I mean, he's the greatest speculator that there ever was. But what happened to that? What happened to that $1 billion? How can you spend $1 billion? He went broke. He lost it. So, and he will tell you that you have to respect your risk. But his personality was such that I don't care. I'm right. I'm going in and I'm going to play this the long run. And if I go broke, it's okay. You know why it was okay for him to go broke? Because he knew he could make it back again. Do you know that? Don't go broke if you don't know that. As you know, when I went in with my first large live account, I overfunded it, $40,000, and I was over leveraged, and I hit those proverbial 6 losing trades in a row right up front. I mean, that took $15,000 or $20,000, boom, right off the table. And then I didn't reduce my leverage because I can make this back. I can make this back. What I didn't understand at the time was I was following other people's rules. You read the books, this is what you do. You watch the videos, this is what you do. You take a course, this is what you do. All that's mechanical stuff, and you can read Trading in the Zone all you want. But until you invest your cash, track your trades, and study your mistakes, all that stuff isn't worth shit. And it isn't worth shit to start with. Because those educators, from my viewpoint, my opinion, I've got a bachelor's degree in physics, I know how to solve problems, I've got a lot of math background behind me, I've done a lot of reading, I understand this stuff, and I was successful in real estate. Trading currencies and trading real estate's the same thing. It's a time frame that's different, and it's your emotional ability to deal that's different. Try to teach that in a book or video. You can't do it unless you are knowledgeable enough to put that stuff in there, and then you don't sell very many courses and you don't sell very many books, and nobody's going to watch your videos because nobody wants to hear that shit. They want the magic pill. Oh, if I do a fast MA cross slow MA and 8 over a 21, I'm going to be, in the long run, I'm going to be successful. Boom, that's what I'm going to do. Or I'm going to do the Fibonacci of spiral of death thing, as Rob Booker calls it. All this kind of shit is just people that don't want to do the work and listen to the reality of things and take the easy way through. Jesse Livermore said, the only way you get a real education in the market is to invest your cash, track your trades, and study your mistakes. If you don't, number one, do those three things, and number two, if you don't look at the emotional side of it, how that correlates with the mechanics, the plumbing of what you're trying to do or what your system is, then it's very unlikely that you're going to be successful. You know, a major brokerage did a statistical study of 43 million of their trades and determined that 90% of the traders lose 90% of their money in 90 days. Why is that? That's what happened to me. And I read all the books. I took a course, 2 courses, and I watched hundreds of videos. I watch hundreds of books. I don't know whether you can see behind me, but all these books are trading books. All of this whole bookshelf. And then those are the ones that are left that are partially good. I threw the rest of the junky ones out. They all have something to say. But if you just do it wrote out of the book or off of a video, it isn't going to work. That's not the way Livermore did it. Livermore invested his cash, he tracked his trades, and he studied his mistakes. You got to know what to track, though. You have to understand what to track and how to correlate it, and how to correlate that with your emotional well-being at the time that you made the mistakes that you made, so that you can recognize your emotions when you sit down to make those trades, and recognize that the reason that you don't want to get out of that trade and take that loss when it's starting to exceed your limit is because of your emotion, not because of whatever's going to go on the chart that you think may manifest itself because it's Tuesday and the Fed report isn't until Friday. No. That's not valid. It isn't going to make the wash. You understand what I'm saying? I hope you do, because this is critical stuff. I learned it the hard way. I've lost $50,000 doing this stuff. I'm back to trading mini account, $1,000 account, and I'm even out of that. I haven't traded in the last 2.5 months because I let that trade run. I just let it run. Every day I'd say, well, it's going to come back. It's going to come back. It went through the 8 period. It went through the 21 period moving average. It went through the 55. Went through the 100. Went through the 200. Hundreds of pips against me. And finally I just said, you know what? I don't give a shit. I understand what happened. I let my emotions get away from me. I broke my rules. That's another thing that Jesse Livermore said. The only time I ever lost money was when I broke my rules. I've lost a lot of money in that account. I did a video on that. I lost 57% of my account. And so when I did that, when I finally closed the trade, I just shut the thing down. And I haven't traded since. That was the end of March, I think. And it's now 1st of July that I'm recording this video. And I said, okay, July 1st, I'll start trading again. So I come down and I look at the thing. And I'm not going to trade in this crap that's going on right now in the currency pair that I do. So I'm sitting here and I'm drinking a cup of coffee and I'm chatting with you folks instead of trading, because there's nothing to trade. There's no reward that's worth whatever the risk is that's going on in this turbulent market that's been going on the last couple of days. So please read more into Jesse Livermore's quote than you would just read. You got to feel it. You got to read between the lines. The only way you get a real education in the market is to invest cash, track your trades, and study your mistakes. I'm Peter Rose, founder of Longwood Currency Trading. Thanks for watching my video. Have a great day and have a great trading day.